The German economic model, which relied on cheap gas imports and high-quality industrial exports, has been considered to collapse following the conflict in Ukraine and the rise of other emerging powers. According to experts, Germany's business model will no longer be able to ensure the country's prosperity in the coming years. In this context, many opinions suggest that the largest economy in Europe is facing deindustrialization due to its economic development policies and trends. This raises the question of how Europe will be affected when Germany's economy falters. What has led the country to face bleak economic prospects at the present time? Let's explore these issues in today's World Affairs. According to a recent analysis titled Europe's Economic Engine is Stalling, Germany deindustrializes by Politico. Germany's largest companies are currently leaving the country. Chemical giant BASF has been a pillar of German business for more than 150 years, underpinning the country's industrial rise with a steady stream of innovation that helped make Made in Germany the envy of the world. But its latest moonshot, a $10 billion investment in a state-of-the-art complex the company claims will be the gold standard for sustainable production, isn't going up in Germany. Instead, it's being erected 9,000 kilometers away in China. Even as it chases the future in Asia, BASF, founded on the banks of the Rhine in 1865, is scaling back in Germany. In February, the company announced the shutdown of a fertilizer plant in its hometown of Ludwigshafen and other facilities, which led to about 2,600 job cuts. We are increasingly worried about our home market, BASF Chief Executive Martin Bruder-Müller told shareholders in April, noting that the company lost 130 million euros in Germany last year. Profitability is no longer anywhere near where it should be. Such malaise now pervades the whole of the German economy, which slipped into a recession in the first quarter, amid a flurry of surveys showing that both companies and consumers are deeply skeptical about the future. That concern is well-founded. Nearly 20 years ago, Germany overcame its reputation as the sick man of Europe, with a package of ambitious labor market reforms that unshackled its industrial potential and ushered in a sustained period of prosperity, driven in particular by strong demand for its machinery and cars from China. While Germany frustrated many partners by exporting vastly more than it was buying, its economy flourished. The boom times, however, came with a cost. The economic strength lured its leaders into a false sense of security. Their failure to pursue further reforms is now coming back to bite. Suddenly, a perfect storm is brewing over the former European powerhouse, signaling that its current recession isn't just technical, as policymakers pray, but rather a harbinger of a fundamental reversal in economic fortunes that threatens to send tremors across Europe, injecting even more upheaval into the continent's already polarized political landscape. Confronted by a toxic cocktail of high energy costs, worker shortages, and reams of red tape, many of Germany's biggest companies, from giants like Volkswagen and Siemens to a host of lesser-known smaller ones, are experiencing a rude awakening and scrambling for greener pastures in North America and Asia. Absent an unexpected turnaround, it's hard to avoid the conclusion that Germany is headed for a much deeper economic decline. The reports from the front lines are only getting worse. Unemployment rose year-on-year by about 200,000 in June, a month when companies normally add jobs. Though the overall unemployment rate remains low at 5.7%, and the number of job vacancies high at nearly 800,000, German officials are bracing for more bad news. German Labour Office head Andrea Nalli said, "We're beginning to feel the difficult economic conditions in the labor market. Unemployment is rising, and unemployment growth is losing momentum." Foreign interest in Germany as a place to invest is also receding. The number of new foreign investments in Germany fell in 2022 for the fifth year in a row, hitting the lowest point since 2013. One sometimes hears about creeping deindustrialization. Well, it's not just creeping anymore, said Hans-Jürgen Volz, chief economist at BVMW, an association that lobbies for Germany's Mittelstand, the thousands of small and medium-sized firms that form the backbone of the country's economy. To understand the long-term effects of deindustrialization, one needn't look further than America's Rust Belt or the UK's Midlands, once thriving industrial corridors that fell victim to policy missteps and global competitive pressures and never fully recovered. Only with Germany, the consequences would play out on a continental scale. The country's reliance on industry makes it particularly vulnerable. With the exception of software maker SAP, Germany's tech sector is essentially non-existent. In the financial world, its biggest players are best known for making bad bets, such as Deutsche Bank, and scandals such as Wirecard. Manufacturing accounts for about 27% of its economy, compared with 18% in the US. A related problem is that Germany's most important industrial segments, from chemicals to autos to machinery, are rooted in 19th century technologies. While the country has thrived for decades by optimizing those wares, many of them are either becoming obsolete or simply too expensive to produce in Germany. Take metals. In March, the company that owns Germany's largest aluminum smelter, Udisheimer Renwerk, said it would shutter the plant by the end of the year due to the high cost of energy. Such reports would be less worrying if Germany had a strong history of economic diversification. Unfortunately, its track record on that front is patchy at best. Germany pioneered modern solar panel technology, for example, to become the world's largest producer in the early 2000s. After the Chinese copied the German designs and flooded the market with cheap alternatives, however, Germany's solar panel makers collapsed. In biotech, Mainz-based firm BioNTech was at the forefront of the development of the mRNA vaccine that proved crucial in helping the world overcome the COVID-19 pandemic. But on the back of that success, the company announced plans in January for what its founder called a huge investment in cutting-edge cancer research in the UK. Innovation begets economic growth, and as Germany's traditional industry declines, the question is, what big new thing will replace it? So far, there's nothing in sight. Germany ranks only 8th in the Global Innovation Index, an annual ranking compiled by the UN's World Intellectual Property Organization. In Europe, it's not even in the top 3. In artificial intelligence, a technology many observers believe will drive economic growth for the coming generation, Germany is already an also-ran. Only 4 of the 100 most cited scientific papers on AI in 2022 were German. That compares with 68 for the US and 27 for China. Germany has nothing to offer in any of the most important future-oriented sectors, said Marshall Fratzscher, the head of Germany's DIW Economic Institute. What exists is an old industry. The power of technology to transform an economy or leave it behind is apparent when comparing the trajectories of Germany and the US over the past 15 years. During that period, the US economy, driven by a boom in Silicon Valley, expanded by 76% to $25.5 trillion. Germany's economy grew by 19% to $4.1 trillion. In dollar terms, the US added the equivalent of nearly 3 Germanys to its economy over that period. The erosion of Germany's industrial core will have a substantial impact on the rest of the European Union. Germany is not just Europe's largest player. It also functions like the hub of a wheel linking the region's diverse economies as the largest trading partner and investor for many of them. Over the past 3 decades, German industry has turned Central Europe into its factory floor. Porsche makes its top-selling Cayenne SUV in Slovakia. Audi has been churning out engines in Hungary since the early 1990s. And premium appliance maker Miele makes washing machines in Poland. Thousands of small and medium-sized German firms, the so-called Mittelstand, that forms the backbone of the country's economy, are active in the region, producing mainly for the European market. While they won't disappear overnight, a sustained decline in Germany would inevitably pull the rest of the region down with it. There's a danger that Europe will end up being the loser in the shift, Klaus Rosenfeld, chief executive of Schaeffler, a car parts maker, acknowledged recently, adding that his company was likely to build its next plants in the US. While EU officials have blamed the region's looming deindustrialization on what they see as unfair policies in the US and China that place European companies at a disadvantage, the problems in Germany run much deeper and are largely homemade, and they don't have easy fixes. Put simply, the formula that made Germany Europe's industrial powerhouse, a highly skilled workforce and innovative companies powered by cheap energy, has come undone. As a generation of baby boomers retires in the coming years, Germany is speeding toward a demographic cliff that will leave its companies without the engineers, scientists, and other highly skilled workers they need to stay competitive in the global market. Within the next 15 years, about 30% of Germany's workforce will reach retirement age. The graying population isn't the only issue. Young Germans yearn for safe jobs, not the rough and tumble of entrepreneurship and invention that made the country one of the world's leading economies. Efforts to compensate for the growing worker shortfall through migration have so far failed, though Germany continues to take in hundreds of thousands of asylum seekers every year, most lack the skills companies need. Recently, German lawmakers passed a new immigration law that lifts many of the bureaucratic barriers foreign skilled workers have faced to settle in the country. Whether it will work is another question. Compared with the UK, Canada, or the US, Germany is often a tough sell due to high taxes, the difficulty of learning the language, and a culture that is often less than welcoming to foreigners. Compounding those demographic challenges are skyrocketing energy costs in the wake of Russia's war on Ukraine and Germany's own efforts to combat climate change. For the economic relationship between Germany and China that represents a sea change, for decades the Chinese viewed German industry and engineering as a model. All of a sudden, it's the Germans who are looking to China. According to many experts, the big Chinese auto companies will soon have to build their own factories in Europe and maybe even in Germany. It was a trend that can't be reversed. Given the economic headwinds, it's perhaps no surprise that many of Germany's biggest companies are on a path toward being German in name only. And this has come to an end of our program today. Thanks for watching and see you next time. Goodbye.